One of my traders lost over $150,000 before lunchtime. I feel compelled to share this experience with you, go over the trade itself, the lessons learned, and the trading takeaways to help you avoid this type of outcome. Let's do this. Hi, I'm Christoph Marzek. I've been a professional trader and investor for nearly 2 decades, and I'm on a mission to help you make better trading and investing decisions to ultimately better your life. All right, this video is very elegantly called Blowing Up with the subtitle of Kaplooey. All right. The way this video is going to be structured, we're going to go over the trades, the event itself, what exactly happened. We're going to talk about the story. There's some context here that led up to this day. Okay. We're going to talk about what happened psychologically to this trader of mine who lost over $150,000 in a matter of an hour. Frankly, it was about an hour, maybe 2. And what are the trading takeaways and lessons learned to help you avoid this type of calamity? All right, but before we get started, I do want to read one part in this great book. It's a fantastic book. Grumpy Monkey, okay? Grumpy Monkey, I read last night to my son. The timing couldn't have been better. Hear me out. Norman the Gorilla says, learning from your mistakes is great, but learning from others' mistakes is even better. Okay, with that said, let's do this. Okay, let's define blow up for a moment. Blow up, firstly, is when an account takes an outsized loss, typically the totality of the account's size or even beyond, or a large percentage of what's in the account in one trade. Okay, in my experience, I've had 2 blow ups. You can watch my videos of my early days, but when I was a retail trader, just to tell you briefly, when I was a retail trader, I started off with an account. I blew it up. I took it to zero. This was in college. I worked one summer. The next school year, I reopened the account, tried again, blew it up again. Okay, so those are my early days. I've also, during my professional years, had about one, I'd say, blow up where it was just a larger loss. Again, never in totality, but and about 3 others, again, similarly large losses. So I know what it feels like. All right, the trade. The date was December 29th, 2025. The market was gold. And some context here on the market, okay? Gold was loose. Gold was volatile most of that month, and especially into the last 2 weeks of the year. Notice this is a holiday time here, folks. This is a sensitive time. Things are a little bit more thin. People are out of town. Markets can move a little bit more dramatically. Nevertheless, let's go over what the trades were. All right, so this is a 15-minute chart of gold, and this is Christmas. Okay, I couldn't go back to more narrower timeframes, by the way. I wanted to go to 1 minute just to show, or even a tick chart, frankly, just to show some of the intricacies of his decision making. But to go back this far, I could only go to 15 minutes. Okay, so he walked in. I'm purposely showing you kind of like where he woke up. All right, this is what he saw. He saw pretty dramatic sell-off overnight, Christmas Day night, by the way, into Monday. And he was assessing that, okay, we're down 700 ticks in this, and he considered this wick oversold. Okay. Something similar happened here, and he's decided to say, he said to himself, well, if we get back down here, and he drew a support line here, okay, and this, and he had lines. Let's just say that. He had some lines. If we get back down here, I'm going to buy. Because I think that this is overdone. And it's going to rebound. Okay? So we indeed, I'm going to fast forward this as if this was live. We indeed did go down. We went down here. He bought. Okay? He then was pretty quickly not correct. And he bought some more. He bought some more. Okay? It kind of lingered. He thought, okay, I caught the bottom. Now I just have to hold it. It's going to go back up. Then that happened, and I'm feeling it a little bit here replaying this because this was traumatizing for him and for me. And he bought some more, thinking, certainly this has to be the end. At this point, he was down well over $50,000, okay? And he thought that has to be the end. No, it's not. Kept going. Finally, the final puke, if you will, at least in this session. I'm going to kind of pinch this. So all these red bars was him trying to catch a falling knife. ultimately, I think down at the low, he was down about 200. And he ultimately had to puke it somewhere here. Okay. During that day. I know that. It was before noon. Maybe it was on this leg down lower, actually. Okay, so that's what the trade was. And I remember this pretty vividly, but even just to show some proof here, this is a snapshot of his statement where he started off in micros, and this is in reverse order chronologically, where he was buying micros, buying, pretty much every one of those new pivot points. And again, his verbiage was, oh, it hit another level, and it hit another bell curve, and another this, and another that. Okay, lots of reasons to keep sticking with this trade. Ultimately, the puke where he sold. So in the micros, he sold. In the micros, he lost $93,000, and he didn't stop there. Once he ran out of limits in the micros, he then bought some more in gold, thinking it's certainly got to be overdone. It wasn't. He lost $73,000 in the normal gold contract. Okay, so all in one trade session. This was called $160,000. All right. Now there was a lot of lapses in his judgment on this trade, and frankly, honestly, reliving this a little bit was kind of not that easy for me to make this video. But in the spirit of providing you with full transparency and hopefully a way to avoid this, let's go over a little bit more in detail. Okay, let's talk through the trader himself. Okay, firstly, he tried to do this part-time. He tried to be a full-time trader under part-time circumstances. That's typically a little bit red flag number one. Okay, he came from a retail educated background. And you know me and MACD, we ain't friends. I don't like the MACDs, okay? The support lines and things like that. And I'm going to explain why in this video, because you guys are going to hear it often. I'm going to dog on MACDs and everything like that because they give false conviction. That's really the big thing here. They give a lot of false conviction and overconfidence. In general, his trading was very jumpy, I would define it. I swear it was like every single day or every week, he had a new strategy that he was trying. And I was arguing with him, frankly, kind of often on like, dude, you got to be more consistent. Okay. You have to be more consistent on giving things a try. And I was guiding him as best as I could, to be quite honest. And just in general, his strategy of really averaging in was really the big clue here that like, this isn't going to be good. Okay. And he was with me for a few months, and the act of averaging in, let's define what that means. Averaging in means you buy at 100, the price goes to 90, you buy another one, and now your average price is 95. Let's say it goes to 80, you buy another one. Now your average price is 87 something. Okay, that act of like it's going against you, you are wrong. The market's telling you you're wrong, and you're just going to psychologically try to bring that break even a little bit lower. That's averaging in. That strategy does work. Okay, it does have a higher hit rate, if you will. 18 out of 20 trading days, you're going to win. But it's that 1 or 2 days a month that's going to wipe you out, plus some, and be, frankly, psychologically damaging. So I would advise not to average in early in your career. There may come a time where one does average in, but you have to have the wherewithal of your own objectivity towards the market. And we're going to talk a little bit more about that, okay? So one thing is because he was doing that strategy, and why I don't like that strategy is because it has a high hit rate. His confidence, his ego are high, and they're in the strategy. This becomes interesting. The more positive feedback, the more one becomes embedded in the strategy themselves. All of them becomes the strategy. And when that gets tested, is when people lose objectivity of the markets. And that's where calamity like this can happen, okay? I battled him for months about his lack of sound strategy. I'm telling you, I saw the averaging it. I couldn't spend every day with him, but I was like, man, your reasons for getting in more don't sound too sound, okay? They always seem to be a new reason to go in more. And that's what I meant by the jumpiness. It was like you could always point to something. Like, oh, yeah, but now this line, and now that line, and now this support. Like you could always do that. And it's infinite. But if you find yourself continuing to do that, and I had another video about this, talk about your strategies out loud. Revert your strategy back to somebody, or even out loud. Maybe make a recording yourself and see if you sound like this. If you sound like you're jumping around so much. Now, granted, there's a place for jumping around early in one's career where you have to kind of put some feelers out there, test things out, see what's working, see what's not working, but keep it in limited capital. Consider it a research and development part of your investment, okay? Keep that low. Otherwise, you could blow up. All right. Let's talk about the trade itself psychologically. So that was a trader. That was some context of who the trader was and his profile. Didn't have a mentor for me, etc. I mean, there's a lot of other things here. But the trade itself, let's talk about what exactly happened. So he goes into, and he had a 20-day winning streak going into this. Again, using, I don't think it was not sound strategy. It was averaging in. So he goes in, and I think his first couple trades in the day also won. He did the same thing, and it won. So now it was like the tipping point for him was, this is working. This is going to work. Despite me as his mentor was telling him, dude, it's not going to work. You're going to have a blow up. You're going to have a blow up. His conviction was through the roof. His confidence was through the roof. And therefore, his lack of risk awareness was also through the roof. Okay? And what happens? A situation occurred where, and he said this himself, where very, very quickly, he went from being down 1 to 2 grand to down 15 to 20. And he was saying it was into seconds. I re-looked at his trades in detail. I don't have the timestamps on the statement, but when I looked at it back then, it wasn't a couple seconds. It was fast, within 1 minute, but it wasn't a couple seconds. Well, what happens? What happens to a person when all of them are in a trade? All of them are in a strategy. Their ego, their personality, who they are. They've done the trader math. Oh, I have 20 days in a row. If I keep going like this, I'm on the beach, baby, in 2 years. That's a trader. Traders do this. I've done it, okay? When all of a sudden it just very quickly collapses, one becomes frozen. Okay, a deer in the headlights. It's not even fight or flight anymore. It's straight up, they're in shock. They're in denial. There's a little bit of a moment of mourning almost. Like they cannot believe it. And I don't want to relate mourning with financial loss, but there are some similarities here psychologically of they're in denial. Certainly this has to come back. Okay? Let's go through, when is that tipping point? I drew this up where someone's ability to be objective in the markets tends to be dictated by how much they're onsides or offsides, okay? And these lines, I know this is very crude, but I like my Microsoft Paint. So this line here represents one's break-even P&L, all right? When you're making money, when you're on the plus side, you're able to remain objective, typically. It's a little bit easier. Notice the scale is much higher on the green versus the green below when you're losing money, all right? Typically, you can remain objective. Now, there comes a breaking point where one makes too much money and they become less objective, and ultimately where they're just through the roof ecstatic and they've just completely lost touch. And if your job as a trader is to be objective, your job of a trader is to stare at the markets in as much of objectivity perspective as you possibly can, an objective perspective as you possibly can. You have to be self-aware of this. And these lines change based on the person. Some people have this green bar way up higher, and their yellow line is tiny and their red line is tiny. It also depends. So that's intra-person, the person themselves, it fluctuates. How much sleep did you get? What have you been thinking about? Your diet, your exercise, your real-world environment. Where are you coming from? How much capital you have? How much capital you're allocating to this? All of these variables matter on where these lines are, okay? And this is what's making you make or break your objectivity of the market. Now let's look at the downside. It's a little bit tighter, okay? We are tighter to the downside where you can stay objective for a certain amount of loss, but very quickly you become a little bit more blinded and ultimately very blinded. And in his situation, couldn't even look at it anymore. I mean, when I called him when he was down 140, he wasn't even at the screens. He completely burrowed himself. in complete denial, hoping for it to return. And ultimately, he ended up puking. Okay? So this chart, and you guys can take a screenshot of that, is something to be aware of. If your goal is to be objective at looking at the markets, this chart matters. Where are your lines? Okay, you could plot some numbers in here. Well, here's a hint, by the way. I forgot to mention this. If you're finding yourself up, let's say you're here, and you're finding yourself looking at your P&L more than the market, you're entering yellow red zone. You're not thinking. And this is dangerous, by the way, because the market will come back and get you. I'm going to use a term pretty often in some of my videos called neutralize. You have to neutralize yourself daily. Also, the reason why I like short-term trading, because you have the capability of doing so. There's breaks, daily breaks, where then you can go and do what you need to do to neutralize. I exercise, I go outside, I go to nature, I spend time with my family. I have my own neutralizing, okay? I'm a little bit spiritual. I do all those things to help me neutralize, so I can reset the next day back to, all right, I'm always green. I'm always going to try to be green. The times I blew up, besides my early career, the times I blew up is where I wasn't green. I wasn't neutralized. I was tired, whatever. I had lots of variables. You're going to figure that out. All right, so what are the trading takeaways of this situation, of what happened here? Be mindful of your reasons to enter a trade. Are they backed by a sound strategy? Okay. Averaging in, dictated by one's own P&L is not sound. If you're like, I need to get that break-even point closer, that's not a reason to go in. You're thinking already personally. The market does not care about your P&L. Remember this. The market does not care about your P&L. Okay? You have to care about the market, and in the back of your head, keep your P&L. I'd say all noobs should be very sketch and averaging in. It's just a doomsday scenario right waiting to happen. Some of you might even relate to some of this. He failed to remember a very important risk management mindset. This is what it is. It can get worse. This is difficult. This is pro-level stuff here. To be able to be in this area, okay, to be able to be way down here and still be a green bar, still be in neutral, objective territory, takes time, effort, all the things that you need that a professional trader has. Very few people can do it, but those that can are the ones who are telling themselves, this can get worse. When he was down 3, when he was down 10, think about this. When he was down 15 very quickly, his reaction was not, it can get worse. It was hoping it can get better. All right? It was hoping it can get better. And ultimately, that ended up destroying him. And by the way, I should mention, ultimately, that killed his seat at the table. That's another thing about blowing up. Oh, gosh, it's so detrimental psychologically, obviously financially, but psychologically, and also potentially your ability to capture the next edge. This is huge. If you blow up, and blow up could also, again, be defined as just a large loss. Large losses can be detrimental because you're going to miss the next good trade. You're going to miss the next good trade that comes up. And it can come up tomorrow, next week, next month, next year, whatever. You got to keep your seat hot. Okay? Know where your green, yellow, red zones are. The one from the diagram, okay? Maybe that means the percent of capital starts to get to you. Maybe you start looking at your P&L too much. Maybe you're doing the trader math. If I only can do this every single day for 249 trading days, I'm good, bro. I'm good. Be careful once you start saying that. You talk to your spouse, your girlfriend, boyfriend, whoever. You talk about how you're on a streak. Be careful. When your chest is puffy, when you're like Gorilla Norman, be careful. The market will find that. The market will find that. When the tide recedes, it will find who's swimming naked, as they say. You have to humble yourself that you may be wrong. And let's define when that means, by the way. And I'm going to talk about this in other videos. When one is wrong can either be financial. I lost $2,000. I'm wrong. Okay, I don't totally love that philosophy, but it's a good way to at least put the sand, the stick in the sand. Or what I prefer, and I'm going to spend time talking about this in our videos, the expectation of a trade. Is the trade behaving the way you expect it? If all of his 20 winning days was he was on sides within 4 minutes. I like to use time in my trading. If all of his winning days was if I'm on sides in 4 minutes, it's a win. That day where he's off sides in 8 minutes, you shouldn't be averaging in. You should be scaling down. That's what that means. How does one expect a trade to perform? You have to trade to learn, trade to fail, trade to succeed, take notes, do research. Have a mentor. I should have more things in here. Mentorship is important. You need to have somebody objective. The ultimate big takeaway. Your goal as a trader is objectively looking at the markets, viewing the markets without 200,000 years of evolutionary gunk. You're a human that's battling 200,000 years of evolution against stress, survival, etc. And that comes up in your perception of the markets, okay? Time becomes different under stress. He said it went in a flash. It wasn't a flash. I looked at the data, right? It was about a minute. Could he have gotten out? Absolutely. Absolutely. I've seen a flash trade where it's like instant. But could he have gotten out? He could have. Memory becomes weird, distorted. I remember talking to him. It's like he couldn't even quite piece it together. I had to look at his trades carefully and like, dude, like what were you doing? He doesn't remember. It's only he was in that purple. Completely not objective. And why? Because he's battling human. All of us have this, by the way. I'm not any different. I'm not anything special here. Which is why I believe, by the way, because I don't think I'm that special when it comes to figuring this out, I believe you can figure it out. I think any single human being can be a good trader, including you. Okay? All right, the final summary. Why am I sharing this story with you? Okay, I want you to know and realize that this is real. Okay? This is real. This is a real trade that happened. He lost his account balance. I took a hit. And just like Norman the gorilla said, learn from others' mistakes. Finally, I want to leave you with this. Every loss holds a seed of equal or greater value. Don't waste your losses. This was a loss to me, and I'm not going to waste it because I want to share it with you. That's really what I'm hoping for. I'm hoping that this saves all of you some sort of money. Next time you're in a trade, you're like, oh yeah, I remember that video. Guy lost $160,000. Not going to forget that. That's my hope. My hope for you. I hope you got a lot of value for this one. Sorry, it's a little more somber. I will have green trading days and green stories also. So stay tuned for those. But I also hope you have a great day, and I'll see you in the next one. Thanks.